In an increasing uncertain and complex global environment, the relationship between the world's two largest economies is prompting more attention and discussion than ever. Cross-border economic activity is at record high across all segments. I am honored to introduce you Mr. William Yu and Mr. Alan Chu, who will provide an overview of the macroeconomic environment and the perspective from the business side. Mr. William Yu is an economist with the UCLA Anderson Forecast. He joined the forecast in 2011. At the forecast, he focuses on the economic modeling and forecast of the Los Angeles economy. He also conducts research and forecasts on Asian emerging economies, especially China, and their impact on the US economy. He developed the City Human Capital Index and the Los Angeles City Employment Estimate and has been cited frequently in local, national, and international media and various Chinese media. Alan is a partner with PwC and leads the China Business Network for the company in the US. CBN is a dedicated team of bilingual US-China specialists who provide enhanced, integrated, and on-the-ground support for US and Chinese companies engaged in cross-border business and investment activities across various industries. Alan has over 20 years of experience working with Fortune 1000, as well as the middle market companies on inbound and outbound investment in US and China. He is bicultural, bilingual, and has spent more than 20 years in Asia, including 10 years living and working in China, where he led numerous business improvement and internal control consulting and auditing projects for a number of Chinese enterprises and multinationals across China. Please join me in welcoming Mr. William Yu and Alan Chu.
Hello, good afternoon, everyone. So today, Alan and I are very honored to be here again to talk about China's economy in WOOS conference. So today, we're going to give you a macro overview and a business perspective for China. So we are going to talk about China's economy, and we are going to talk about the rising trend of China's investment in the United States. So we hope through our presentation, we can give you a basic foundation and introduction for our great programs and panels following soon. All right, so before I start, I would like to talk about these two shopping bags, as a beginning. So today we are here to talk about the growth strategy, cross-border investment for the goal of what? Of achieving a higher return and rising income. But the ultimate goal of all this is consumption. Okay, America, we are very good at consumption. Yeah, and China, we believe the increase of consumption in China will not only help Chinese, but also help our world economy. After all, consumption is the final measurement of the standard of living. All right, so first of all, let's talk about the state of China's economy. So the chart shows the GDP growth rate since 1991 to 2014. So as you can see, it's up and down, but over the past 2 decades or 3 decades, we can say, by and large, China's GDP growth rate is 10%, around 10%. However, you can see on the right, recent years, China's GDP growth rate has declined to below 8%. Yeah, so right now the question is, will China's GDP growth rate rise again? My answer is very unlikely. And why? The answer is because the past growth model of China's economy is investment-driven, is export-driven, and is not balanced, and is not sustainable. So it's time to change. And Chinese government, right now, they realize that. And so they call it, China is going to have this so-called new normal. Yeah. So what is new normal? Actually, this term was used in the United States economy over the past several years already. So we are debating where United States economy turned to 2.5% growth GDP or not? Because in the past century, we had a 3% growth rate. So for United States, we don't know. We are still debating. But I can tell you for China, we're pretty sure China is entering real new normal. So, so right now, this is the data from World Bank and other institutions. So right now, the consensus is over the next 5 years, the Chinese GDP growth rate will be 7%. And then next 5 years will decline to 5.9%. And from 2026 to 30 will decline to 5%. Yeah. So personally, I think this number is very good. Actually, it's very good. There will be some kind of downside risk. So Alan and I are going to talk about that in a minute. But the most important thing of how does this new normal economy means in terms of structure. So let me show you. China, we all believe the current structure investment as a share of GDP, 42% is way too high. It's way, way too high. And the consumption as a share of GDP, this number including government consumption, but the final number we need to see is household consumption. It's only 35%. It's way too low. So through this kind of adjustment, we expect by 2030, the investment share will decline to 34%, and consumption share will increase to 66%. China has to go this way, and I believe it will go to this kind of adjustment. So, and China will adjust to become more services-focused economy. So currently, industry manufacturing as a share of GDP is around 44%. And the service is 48%. So by 2030, we expect the China's economy will, in terms of industry as a share of GDP, will decline to 35%, and services will increase to 61%. This is all the development and the advanced economy will become. So we expect China will become like that. And in terms of employment in agriculture, currently is 30%, employment in services 42%, and we expect agricultural employment will continue to decline and service employment will continue to increase. So a lot of people are worried about what if China's growth slowing down, how does that impact the employment and social stability? But actually services, industry still need to hire a lot of workers. So I don't think we need to worry too much about that. Okay, so right now let's turn to Alan.
Thank you, William. So central planning, as everybody knows, is a big part of the Chinese economy. So I think there's a lot of, again, focus on what does the Chinese government, from a policy perspective, think about the future. So each year there are these two meetings, 两会, that's what that's about, MPC and CPPCC. And these are kind of the four key points coming out of those two meetings. One, of course, William mentioned, it's about the new normal, 7% growth. And what that's about is how do we do the rebalancing that William spoke about? How do we achieve sort of the more higher quality growth, right, for the economy? We talked about, switching from investment over to consumption, maybe from manufacturing to services. But at the same time, it's also about creating a more competitive economy in terms of trade liberalization and then also maybe private investments within China. It's also about driving entrepreneurialism and innovation. Innovation is a big key. We're going to talk a little bit about that. I think there's a lot of thought about how to collaborate more maybe with other countries such as the US in terms of moving up the value chain. And then of course there are the three key initiatives. Belt and Road, which has to do with the New Silk Road and infrastructure. That has to do with Made in China. It's about rebranding Made in China to make it. It's about high quality manufacturing. And then Internet Plus, right? Tying together, I think, the new internet-based economy. So I think with all of that, I think there's also a lot of anticipation for the 13th five-year plan, which is coming up in 2016. Next slide. Okay, So now, if you take a look at sort of some of the economic indicators that William spoke about and some of the policy directives, now people are asking, okay, so what does that all mean for if I'm doing business in China, or even let's say if I'm doing business in the U.S. looking for Chinese investment? What does all that mean in terms of what's next for the Chinese economy? And so what William had done, and let me just emphasize this, these are not necessarily our own views, okay? We've kind of taken a composite of two differing perspectives about what may happen next. So there's the bearish view, and then there's the more bullish view. Again, I want to emphasize that these are not necessarily our points of view. Okay, so without further ado, let me turn it over to William for the more bearish view.
Okay, yeah. So if you know me, yeah, you will know. I usually is more bearish view about China. Okay, let me explain why. Okay, so I think the first challenge facing China is real estate bubble. So as you may know, China's real estate housing market bubble has burst. Okay, over the past year. So right now the question is not whether it will bust or not, because it has burst, right? So right now the question is how long it will last and how deep the home price will decline, right? And it's hard to say because Chinese government's intervention will change this kind of result, outcome. But I can say is based on all the housing bubble and bust in all the human history, usually this kind of big bubble bust will last pretty long, several years, a couple of years. So that is the things which will drag China's economy to some degree because a lot of growth over the past several years are coming from this real estate construction and infrastructure construction. Okay, and the second challenge is debt crisis. Just like our thing Judy has said about that. The debt to GDP ratio in China is pretty high. And not just that level. The most alarming thing is the rapid increase of the debt over the past 7 years. It's very alarming. So hopefully, China will find a way to resolve this kind of debt problem. Yeah, so that is definitely something we need to look at in terms of the downside risk of China's growth. And industrial overcapacity, yeah, we all know steel, this kind of raw material, a lot of other things. And finally, labor cost advantage, also rising wage in China, losing ground to other Southeast Asia. So that's why we are going to talk about this. How can China increase its value chain? And the second part of political challenge, this is really, really hard to tell what will happen. Because right now the new leadership in China is doing this very serious anti-corruption campaign. So we don't know what will happen. If there's some kind of political instability showing up in China. So we don't know. And finally, social challenge. I want to say is this environmental challenge. Some of you may have heard this recent very popular documentary, Under the Dome in China. So I would say it's kind of funny, if you look at this environmental challenge and GDP growth, actually, in China's case, they play some kind of trade-off role. So if we want to solve environmental challenges, we need to reduce GDP growth, and vice versa. So I believe China and Chinese government will figure out a way to balance these kind of two kind of contradicting goals. Oh, sorry.
Oh, it's okay. It's okay. We don't need to present the bullish view. No, I'm just kidding. I'm giving William a hard time. Those are all very, very valid points. So I think the word really, to me, the key word is rebalancing, okay? Whether there's going to be more of a smooth rebalancing along all these dimensions, socially, politically, and economically. I think there is also a different point of view in the sense that, first of all, if you think about the prime directive of the Chinese government, and that is to maintain social stability. And to do that, the key point is how to maintain higher quality stable growth going forward with the economy. And so, and that to me goes hand in hand actually with the kind of the rebalancing in terms of the environment as well, because there's a lot of I think voices speaking to that in the Chinese society in general. So if you look at the economy, it's what we talked about earlier. Can the Chinese be successful in slowly, I think the slower landing in terms of the economic growth by rebalancing from manufacturing to services, by innovating to move up the value chain, and also by moving up higher on the value chain, that could address the labor cost and labor shortage issue. Politically, yes, William spoke to the anti-corruption campaigns that are ongoing and the results. So I think, as I said, that's kind of a question, right, as to what the impact that be. But I think there's a point of view that the anti-corruption drives are very real and that they will produce results. So that if you look at this picture, right, on the more bullish side or the more positive side, that economically, people say, as an example, the real estate bubble, it is different from the one in the West because lower mortgages, they're tighter lending standards and so forth. So, you know, there are some differing characteristics that may make it possibly more bullish, and then also that the Chinese government's effort for the rebalancing will be more successful than anticipated. So I think, you know, it's good to kind of see both perspectives because nobody actually knows what will happen, but it's good to see both perspectives and then assess what you may want to do, which brings us to our next slide. So a lot of people ask this question: if you're a multinational in China, what do you do in this kind of environment, right? And one of the things that we always talk about, those of us that deal with US-China, is in China for China. That's kind of a slogan now for a lot of US companies. And so if you look across these four categories, that's what it's really about. Product strategy, right? How do you further adapt your products and services so that they are more intuitive and more attractive to Chinese consumers? How do you penetrate the middle market? When I was in China, it was always about premium, premium, premium. But now there's the emerging middle class, which is much bigger. How do you once again address their needs? Business model. So some people believe that the Chinese markets will evolve over time to resemble Western markets. Some people don't believe that. I think the real point there is how do you make your business agile so that it could address either way, right? If the market becomes more Chinese, you have the products and services to serve those. If it becomes more premium, you also have that. Define a clear. This is probably the one I get the most. Is a lot of U.S. MNCs are very concerned about the rising domestic Chinese competition, and I always say, right, that, you know, if you have the right strategy and if you have your competitive advantages, you shouldn't be afraid of that competition. But then if you skip across to partnerships, you know, if you can't beat them, maybe join them, right? That's also a possible strategy, especially nowadays when we have a lot of Chinese companies coming into the U.S. One of the things that we advise our U.S. clients to look at is opportunities to partner with the Chinese clients as they come to invest in the U.S. market. Organization, right? So the whole thing is that a lot of U.S. companies are concerned about, you know, when they're localizing their Chinese management, finding that right balance between the control over their operations and then giving their management locally the autonomy to run their business so that it's a more effective and localized business. And there are ways and strategies that strike that, I think, that good balance. And then, of course, it's about having a good corporate governance structure in which to run your business as a global business as opposed to, say, a US-centric business. Okay, thank you. Okay, so you know, a word about sort of the effort about moving up the value chain and relevance to inbound investments into the U.S. I think this when I first saw this curve, the people spoke about it as if, you know, it was taught in elementary school, but I didn't quite get it. But so bear with me as I kind of explain it. Okay, but most of the people here are probably a lot smarter than me, so maybe you don't need so much explanation. So if you think about the x-axis, right, the horizontal axis, and then the vertical axis is profitability, okay, and then the horizontal axis is the different types of activities in the value chain. So you have resource, research and development and branding, you have assembly, and then you have, say, distribution and selling, okay? So usually the higher profitability, which is the smiling curve, right, is that the profitability are in the two extremes, the higher profitability. As factory to the world, China in the past has been more focused on the middle manufacturing part, which is the lower profitability region. But as you can see, with the rebalancing, they are trying to move towards both directions, right? So to achieve higher profitability so that they can achieve the rebalancing they like, to move into different industries and also within the same industry to move into the more value-added space. And a part of that is to come and invest into the US, which we will talk about in a second. Okay?
Okay. So right now, let me talk about this rising trend of China's investment in the United States. So in this chart, you can see this bar line. The blue line represents the investment in M&A deals and amount, and the green line is the greenfield projects deals and amount. So basically, you can see over the past several years, this investment has risen sharply, rapidly, okay, from probably like 2009, almost nothing, to 2014, $12 billion. So the question is, what will happen next? And my forecast is it will continue to rise. So why? Because even though we see this kind of exponential growth of China's investment in the United States, however, compared to other FDI from other countries like Japan, UK, this amount is still very, very small. So there's a lot of room for China to invest. You know, compared to other countries, China got a lot of money to invest. And right now, China's domestic environment is risky. So United States, on the other hand, has a lot of potential and growth opportunity. So we believe this will continue to rise. So here is the location in terms of China's FDI in the United States. So the largest, concentration place is California, of course. Yeah. Over the past several years, it has total 269 deals, total amount $5.6 billion, followed by Texas, mostly energy sector, and then New York, Michigan, and Illinois. And this is the Chinese investment in the United States by sectors. So you can see in 2009, 2010, energy, and 2011-12, entertainment, and 2013, agriculture and food, and recent year, ICT represent information communication technology, and pharmaceutical, biotech, real estate, auto, all across the board. So it's not a coincidence today in our program, we got all kinds of representative sectors, represent this number. So yeah, we are very excited to see our great panel discussion about how to really succeed in this kind of chance. All right, so this one, this is I believe the most exciting thing I want to talk about today is this venture capital investment. And this is venture capital investment in the United States. Okay, as you can see, recent year is on the rise. And we all know venture capital investment is a driver of innovation. Ellen talked about innovation, right? All the countries right now are talking about innovation because we know that is the most sustainable way to grow your economy. So China is talking about it. But the thing is, innovation, creativity, entrepreneurship is not really easy to mimic, to copy. And here in California, we can say California is the cradle of innovation, okay? And maybe you can agree with me, without venture capital investment, there would be no Google, there would be no Facebook, there would be no Apple today. So I would say venture capital investment is very important. And for Chinese investor company, if you don't have any kind of special strategy, industry or market strategy, you don't have special technology, all you have is money, and you want to diversify, you want to increase your portfolio, I would say this is the best for you. Invest in California. In Northern California, we got Silicon Valley. In Los Angeles, we got Silicon Beach, right? Invest in our smart young people. Invest in our new idea. Invest in our dream. And then you will see the return. You know, we know venture capital investment is very risky. So 95% of your investment will fail. But those 5% will give you a lot of return. Okay, and most important, I would say, you know, through this kind of investment, it's a permanent investment. And then you will really learn. I would say this is the most important ingredient of American capitalism and of American success, venture capital investment. All right. And it will be on the rise.
I'm glad you clicked that arrow, because for those of you that don't know William, he's actually an optimist, believe it or not. So I wanted to quickly finish this because we wanted to leave more time for the innovation panel, which I think is a really, really exciting panel today. We have some really, really good panelists. But just real quickly, I think one key here is that Chinese inbound investors are different from the past. A lot of people like to compare them to the Japanese and the Koreans. And I always say they're not the same, because Japanese and Korean companies, when they invest in the US, carry with them a very large export motive. Chinese investments in the US often is about helping to make the domestic, it's more domestic market facing and helping the domestic companies become stronger in the Chinese domestic market. So I think that needs to be well understood. Okay, next, lastly. So just a quick recap of what we talked about, right? Which is, you know, I think China is moving towards a new normal. How do you succeed in that environment? One big element of that is understanding the government policies, and then one part of that is they want to move up the value chain and therefore invest abroad and now into the U.S. So that's a really, really good opportunity, I think, for U.S. Parties to work with them to mutual benefit. And then the Chinese investors we talked about is different. So developing a bridge to help each other and reconcile the differences and succeed to mutual benefit is a key to mutual benefit. Okay, thank you.
Thank you very much.